Welcome to Close of Business. I'm Alicia Barry. The twice-yearly reporting season for ASX-listed companies is underway, with Australia's biggest companies opening up their books. Analysts expect company earnings to be soft this year as Trump's chaotic tariff regime bites and consumer caution puts some businesses on the back foot. We'll look at how the market is reacting shortly, but first here's Nadia Daly with the story.
Donald Trump's ever-changing tariffs, surprise interest rate decisions. The past year has been characterised by chaos and uncertainty, which is expected to loom large on the balance sheets of Australia's major companies.
What we've seen over the last 6 months is equity markets push on to new all-time highs, both here in Australia and offshore. But this has happened at the same time that the earnings expectations have been nudged down.
I think what the market's looking for is earnings growth for a start, because we have not seen enough of that, clearly, and also a catch-up to where share prices have found themselves.
As corporate Australia opens its books, the report card isn't expected to be rosy.
When you look across the ASX 200 index, profits are expected to fall by about 2% this financial year. Overwhelmingly, that's been driven by resource equities. When we look at mining and energy companies, they're seeing their profits fall by about 20%.
Rio Tinto's already revealed its profits were hit by weak iron ore prices, oversupply and slowing demand from Australia's biggest trading partner, China. The same pressures will weigh on BHP's and Fortescue's earnings. Also in focus, the results of the largest company on the ASX, the Commonwealth Bank.
Its performance over 12 to 18 months has been so extraordinary. If it disappoints in a meaningful way, that's going to have real ripple effects.
The capital return from the banks will be less than what it used to be. So I do think that sector is looking quite expensive.
The banking space is expected to see no profit growth into FY26. And it could be that what we've seen in that area of the economy is already as good as it gets.
With cost of living pressures and just 2 interest rate cuts this year, consumers have been reluctant to open their wallets.
The consumer space is in the back foot, healthcare are in a tough space. The interest rate relief that they expected this year to eventually help profits is not yet being seen, and therefore the analyst community is likely to push out further their earnings recovery stories.
Despite tough trading conditions, analysts still expect some good results.
The owner of Kmart and Bunnings and Target, Wesfarmers has performed really strongly over the last 12 months. JB Hi-Fi is up 60%. And a good chunk of that performance over the last 12 months has been the fact that analysts and investors were expecting really poor performance.
This reporting season will see more corporate concessions about the impact of US tariffs.
There's a couple of selective companies that gets impacted directly. For example, a company like Ansell or a company like Breville, where they do manufacture those products in tariff-affected countries.
You look at something like Lovisa with dramatic store rollouts. Is that going to be impacted? And then you look at a company like ResMed as well, which currently has an exemption from the tariffs.
While labour costs and inflation are putting pressure on margins and a rate cut that failed to happen last month is dampening consumer sentiment, the outlook for the year ahead is expected to be more positive.
This will be interesting reporting season because it's likely to be the bottom of the Australian economic activity, probably one of the last bad results, if you like, because looking forward, things should get better.
Hopes of green economic shoots in a very uncertain world.
It was a dreadful week for the market operator, the ASX, with its virtual monopoly under threat. It also made an embarrassing mistake with TPG Telecom shares. On Thursday, the corporate watchdog ASIC said it's in the final stages of allowing another stock exchange, the US Cboe Group, to enter the Australian market. The ASX also flagged a $35 million hit from ASIC's ongoing inquiry into its practices. A day earlier, the ASX confused listed company TPG Telecom with a similarly named foreign private equity group that was engaged in a huge takeover.
We have grave concerns about the management of that project, the management of the exchange and the accountability around the decisions that are being made.
As for TPG, the telco is understood to be considering its legal options. The US President Donald Trump has ramped up efforts to influence the US Federal Reserve, tapping his top economic advisor, Stephen Miron, to temporarily replace outgoing Governor Adriana Kugler. It's the latest salvo in his attacks on the Reserve and its chairman, Jerome Powell, who Trump has labelled a numbskull and a stubborn moron over the board's refusal to lower interest rates. The Harvard-educated Miron has previously argued for greater presidential control of the board. Miron will serve until January next year, while Trump searches for a permanent replacement. The share market pulled back from record levels at the end of the week, but the ASX 200 and the All Ordinaries still gained around 1.7% each. Economic futurist Evan Lucas joined me after the end of trade. Evan, the ASX 200 hit a record this week, as did the All Ords, in fact. What have investors been getting carried away with?
Everything. I think that also needs to be pointed out here. It is clearly rate-sensitive stocks. If you look at the rally that's been going on in discretionary, particularly players like Wesfarmers, JB Hi-Fi, even to some extent Harvey Norman, Temple & Webster, then also gold, you can't get apart the fact that risk-off trading is actually leading this movement. In equity markets, gold stocks are absolutely going gangbusters, but it is broad-based. CBA stepped back from correcting as well, and they are adding, huge chunky points. They are also rate sensitive and exposed to what we expect will happen next Tuesday. So yes, for the first time in the ASX's 25-year history, it has breached 8,800 points. It got up to 88.49 intraday on Wednesday, but there is, buy the rumour, sell the fact, standing at the precipice of earnings season, because I think no matter what earnings season tells you, it's going to be very, very hard to get a PE ratio that's now staring at the barrel of 19 times earnings to justify even with a better than expected earnings season.
Yeah, well, that kind of brings me to the next question. Do the fundamentals support the levels that the market is currently at?
Well, fundamentals is a funny word these days, and why I sort of put that to you is that if you look into the States and you look at the NASDAQ, for example, because all of this drive is around tech as well. It's all around AI, digital revolution, etc., the PE ratio of the NASDAQ is in the 20s. Now, historically, it's not normally near that. If you look in the S&P 500, it's at the top end of 17 towards 18, again, driven by tech. We here are also trading at a premium, yes, to the fundamentals, but if you go back and have a look at the market in the pre-COVID world, fundamentals have sort of been put to one side. The price momentum is there. The premium price in highly, highly recommended stocks continues to be there, and that's been a trend not just in the last 5 years, but over the last 15 years. So the fundamentals, yes, they are screaming in some sectors overbought or overdone. The market's been ignoring that now for a period of time that you would argue is historical. 10 years is enough to start saying maybe the fundamentals need to be changed about what standard PE ratios are.
Well, if we look more broadly, tariffs are a big issue for investors as well, and pharmaceuticals are in the firing line from Donald Trump. What does this mean for our big listed companies like CSL?
Yeah, so this is an existential, issue that these companies can't face. They have got probably two options to look at. Do you invest into the US completely on your manufacturing and your outlook for your business for a scenario that could be finite? Because the Trump presidency, whether it rightly or wrongly, will end. It will come to an end in 2028, 29. And therefore, do you take a shorter term view and therefore make that kind of investment that could end up being overdone because it doesn't need to be done? Or do you go for the latter and look at an idea of dealing with the here and now, getting through it as much as possible, expecting that there will be give and take on those tariffs and that they can survive? That's where CSL finds itself at, because again, the business itself is still without doubt the number one in blood plasma products. It is still number one in things like vaccines. Most of its manufacturing is there. So it's a push-pull. And again, healthcare has an existential crisis of nothing of its own making, but it is a scenario that clearly they're going to grapple with at C-suite.
And briefly, the market operator, the ASX, was very much in focus. It had a terrible week this week, but it really builds on a decade of woes.
I mean, when you're a monopoly, you don't really have to, grow or increase productivity. Now that there's the threat of CBOE, that's now front and center. This is a business that still has margins of 40% or more. I mean, that's better than most tech companies in the US. With competition, they're going to have to look at two things. Do they start cutting price, keeping market share and competing? Or do they hold sway and hope that CBOE packs its bags and goes home because it can't grab enough market share? Telstra has tried that with Optus and it didn't necessarily work, and it's probably going to be the same with the ASX, with CBOE coming into the market too.
Evan Lucas, thank you so much.
Thank you, Alicia.
The owners of Optus are being taken to court by the Australian Information Commissioner over the cyber attack on the telco in 2022. Singtel Optus and Optus Systems are being accused of failing to protect the personal information of 9.5 million Australians for nearly 3 years leading up to the data breach. The telco apologised again to customers and says it'll consider the matters raised in the proceedings. If it loses the case, it faces a fine running into the tens of millions of dollars. Payment reforms by the RBA to ban card surcharges may reduce costs for consumers at the point of sale, but there are warnings banking may get more expensive. International research shows banks overseas hiking card charges or reducing reward programs to recoup lost revenue from lower payment fees, as Emily Stewart reports.
Many Australians like the convenience of tapping, but not the card surcharges that come with it.
I feel it's pretty unfair. I use cash because of the fee.
While surcharges are set to be scrapped, consumers might end up paying more for their banking or lose rewards offered on credit cards.
Getting rid of rewards will affect me. I'll definitely, maybe I'll cancel or something like that.
The Reserve Bank's proposal to cap interchange fees means banks will miss out on $900 million each year.
They need to recoup it somewhere if they want to maintain the same level or even increase their revenue.
Thank you.
Surcharges are already banned in Europe and the UK.
Based on research evidence internationally, it seems like banks usually just increase card fees, or they will cut back on rewards program or reduce the offering of free services.
The peak body for small businesses says the RBA's proposals could mean higher payment fees for his members.
The concept of lowering that interchange fee, we're absolutely supportive of. What has happened each other time that they've lowered one fee is another fee has increased, or the service package that is provided to the merchant changes.
And if payment costs can't be passed on to customers, small businesses may have to increase prices.
45% of small business owners are earning less than minimum wage. There is no margin here to just instantly absorb these costs. Big business aren't surcharging because their cost structure of merchant fees is less than a quarter of what small business are paying.
The Big Four banks have refused to comment about how they'll recoup costs if the RBA's proposals go ahead. They say they're currently giving feedback to the central bank about the impact of the changes.
If the economics of our payment systems change, then of course business models will also change accordingly.
The banks want Apple and Google Pay to be included in the review.
We would suggest that there's also opportunity to look more broadly at digital wallets and other forms of payments in the system.
It's becoming more popular to tap with mobile phones, with payments up almost 30% in a year.
It's easier, it's more convenient, just carrying one thing rather than multiple items.
And it's costing banks. Each time a customer makes a transaction, the bank pays the tech giants a fee. Professor Zhong says these charges could be offset.
It will require reforms in other areas in terms of the service fees charged by mobile wallets to Australian banks,
allowing Australians to tap and go in a payment system with lower fees.
The ATO is accusing one of Australia's best-known brands of ripping off taxpayers. It's challenging prominent chicken producer Ingam's over its $50 million tax offset claims for research and development. The company says it'll vigorously defend its position. Daniel Ziffer reports.
Ingham's is a big name in corporate Australia. It supplies about 40% of the poultry market. Now, The company is stuck in a multi-million-dollar dispute with the tax office over incentives claimed for research and development for the feed the chickens eat.
It has to be genuinely different, innovative, changing either the way we do things, changing a product itself in a substantive way.
But often it comes down to the evidence, which is very specialised, very technical.
More than $11 billion a year is on offer to encourage companies to spend money on research to develop new products and services. There's regulation, reviews and audits in the scheme. But as the stalled financial accounts of Ingam's Group show, even a company worth $1.3 billion on the stock exchange can get caught up in proving that what it's claiming for is truly innovative. In its most recent annual report, Ingham's Group says it's been undergoing an audit over an adjustment approximately equal to the offset claimed of $8.5 million a year from 2019 to now. Barrister Piotr Klank isn't linked to the case, but says R&D incentive disputes are tough.
You've got the science, the law and the accounting or tax policy. You've got concepts which are simple in theory but difficult to apply in practice.
One of the key issues, businesses need to prove that there was no other way of doing what they did.
One may assume that if an activity was undertaken, there was a reason for that and you did that activity to find out something. But that's not how the legislation operates.
The tax office didn't respond to specific questions and is subject to laws restricting its ability to comment on individual and company disputes. In a statement, it said companies self-assess their eligibility for R&D claims. However, the ATO has sophisticated systems in place to identify possible non-compliance, including undertaking risk reviews and audits. The dispute is ongoing, and Ingham says it'll go to court if needed. Catherine Woodthorpe has spent her life on the business side of science, from technological equipment sales through to the venture capital that funds many innovative startups.
Research and development drives productivity, it drives opportunities, it drives our whole economy, really.
As a percentage of our gross domestic product, Australia spends about 1.7% on R&D. Many European countries are more than 3%. Japan is 3.3%, the US at about 3.5%, and South Korea spends over 4%. Companies can apply for a tick of approval before they begin, but there's a reason most applications happen afterwards.
You're required to anticipate what your R&D activities will look like. And one of the things about research is that the activities can change.
A system trying to boost innovation to get our economy cooking.
Australia's housing crisis is well documented, but over the ditch, New Zealand has been enduring a very different property problem. After reaching an all-time high during the pandemic, New Zealand housing prices have crashed by around 20% from their heady peak. Westpac New Zealand's chief economist Kelly Eckholt joined me from Auckland. Kelly Eckholt, welcome to Close of Business.
Hi.
The latest Cotality data shows a 0.2% fall in July. The housing market in New Zealand still subdued. Can you paint us a picture?
I've been describing it as a well-balanced market. So for the first half of this year, we've seen prices rise by about 1% in aggregate. Most of those rises were concentrated in the first part of the year, where there was a steady string of small monthly rises. But as you pointed out, the most recent Cotality data and some of the other measures suggest that prices went backwards in June and probably in July as well, perhaps to a slightly lesser extent. And you know, when I look at that, I sort of see that whilst there is some signs of increasing demand in the housing market, because interest rates in New Zealand have actually fallen quite a long way since about August last year, and the Reserve Bank started cutting rates. At the same time, there's actually been quite a marked increase in supply into the market as well. And as all economists say, when supply equals demand, then the implications for the prices don't move very far, and that's pretty much what's going on.
So I'm interested in what's been behind the big price falls that the market's seen, especially given interest rates in New Zealand were at 5.5% for half of 2023 and half of 2024.
In the sort of aftermath of COVID, when fiscal policy started to get tightened, monetary policy got tightened, as you say, interest rates went 5.5%. And that was really the sort of like the key story there and sort of causing those prices to pull back. There was a period of stability and prices started rising through the second half of 2023. But as we went through 2024, businesses and households began to realise that it was going to take a while before the economy sustainably turned around. And we then started to see prices start to go backwards a little bit from the middle of 2024 especially.
So is housing more affordable then? And of course, you need to have a job.
Well, you certainly need to have a job. Housing in New Zealand is expensive on the basis of international metrics. Here at Westpac, we have a model which tries to value sort of where house prices should sit from an investor's perspective. And what we see from those estimates is that house prices were quite overvalued a few years ago. So they weren't really a good deal. But now that interest rates have gone down, and also as the government has adjusted some of the taxation arrangements to make it more favourable for investors, those prices now look like they're a bit undervalued. So it's not a surprise to me that I see investors in the housing market increasingly returning.
Australia is going through a different housing crisis. I mean, trying to enter the Sydney market requires 13 times income in some parts. In New Zealand, it's more like 6 times. Do you have any lessons for Australia?
Well, I certainly one factor that I think is really helping the house prices not rise significantly through this most recent period of recovery has been that the supply response into the market has been more flexible than it has tended to be over the last 20 or 30 years. I mean, one of the drawbacks of the New Zealand housing market is that when demand has increased, perhaps because the economy picks up or if interest rates go down, there's been a relatively inelastic response from supply, so prices have just shot up. Actually, what we're seeing in recent years is there's been some easing in planning rules, which has actually freed up the supply of housing. So in big cities like Auckland, there's increasing densification in some of the suburbs, which might have typically had larger single-family homes. So there's a real increase in the supply of townhouses and apartments. These are at more attractive price points, particularly for first home buyers. And I think that is one of those factors that has helped.
Kelly Eckholt, thank you so much.
Pleasure. Thank you very much.
From red light therapy and ice baths to stem cell treatments, more Australians are buying into the growing wellness industry. It's worth $2.5 trillion globally. Proponents say it's the key to turning back time, but doctors are urging caution. Nadia Daly reports.
I'll wake up, first thing I do in the morning is a 4-minute ice bath at 3 degrees.
For tech entrepreneur Christian Sternson, health and wellness isn't just his business, it's a way of life.
My wife will call it an obsession. I call it a passion. Red light for your hair to make sure your hair doesn't thin as you get older. I take my blood works, there's about 65 different markers that I track.
He's one of the founders of Super Young, a Melbourne longevity clinic among the many companies vying for a slice of the growing global wellness market. Worth $2.5 trillion, according to consulting firm McKinsey.
My name is Brian Johnson. I've been spending millions of dollars creating an anti-aging protocol.
I love red light therapy.
Negative 165 degrees in a cryotherapy chamber for 3.5 minutes, which is quite extreme.
The movement promoting alternative or emerging health practices is often at odds with established medical bodies.
The evidence base for a lot of them is minimal. I'll often talk to patients when they are talking about these tests and ask them, what's the cost of this? And ask them, like, who is most likely to benefit? Is it you or is it the person who's selling the test?
But the industry is being driven by insatiable consumer demand to measure and optimise personal health and even turn back the clock.
stem cells in there. I do stem cell treatments in the US. So I will do umbilical cord stem cells and I put that into my body. That's a real big anti-aging process for me. My biological age to 34 from what was at the time a chronological age of 45.
I would just recommend people to be pretty cautious because the majority of the benefits around health and well-being unfortunately come back to stuff which sometimes seems a bit dry, which is around exercise advice and diet.
Eucalyptus is another Australian company riding the $1 trillion wave. Last year, the startup launched a longevity app for men, but pulled the pin soon after with hopes of relaunching in 2026.
The patients really had a curiosity about their own diagnostics, were really keen to kind of make behavioural change, but probably weren't willing to pay out of pocket $1,500 a month, which is what we were charging at the time.
Even so, the company, backed by Woolworths and Blackbird, has had a meteoric rise, led by its weight loss service, where customers can access prescription drugs like Ozempic via a telehealth app.
Ultimately, more care is moving online.
Do you feel that you're disrupting the health system?
No, I think we're an evolution of where healthcare will definitely go. I think we make things more convenient, raise continuity, provide an array of services on a single platform.
CEO and co-founder Tim Doyle says more than 100,000 people around the world bought weight loss drugs through the business, which kicked off just as the drugs became a global phenomenon.
There is obviously a lot of money to be made in that Ozempic craze, so very savvy business model for sure. But is it ethical?
Oh yeah, I think ultimately these medications are going to change the world for the better.
But the model of online prescriptions has been criticised by the body representing general practitioners.
We do have to be really careful of other providers who are potentially fragmenting care, because it's important that whoever else you see in the health system, that they confirm and share information with your usual GP.
Rather than competing with the existing model of healthcare, these businesses say they're providing something different.
I don't think we're disrupting the current healthcare system. The current healthcare system is really, really good when you're sick. If people are willing to pay money to do it privately, which is what we're doing, you can get whatever test you need because you're funding it, not the Medicare system.
On the quest to stay forever young.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.